right, Dan, welcome to the podcast today.
Thanks, Jamie. Good to be here.
So I was thinking, leading up to this podcast has been certainly many months in the making, but in other ways, I would say many, many years in the making. We've known each other for a while now. We've been talking about doing this podcast since you came on at Solaris. And I think now is a very, I would say, opportune time to be having this conversation. You've got a lot going on. There's a lot going on in the markets, in the copper space in particular. So welcome to the show. I'm excited to have you here, and let's get into it.
Let's do it.
Okay. I've been looking at my list of questions today. I'm not entirely sure where to start, but I think for people listening at home, let's give them the sort of elevator pitch of who is Dan Earle? What is Solaris? What are you guys doing?
Yeah, sure. So who's Dan Earle? Well, currently I'm the president and CEO of Solaris Resources. Prior to Solaris, I was an equity research analyst at one of the major banks covering precious and base metals, with a particular focus on exploration through development stage companies. And some of them went on to become, emerging producers and then, growing diversified producers. But I did that for 12 years. And then in my life prior to that, I was working in industry. Now I was educated as a mining engineer like you were, Jamie. And I did the exploration specialization, which is sort of like a hybrid of economic geology with more traditional mining engineering. And so that was my educational background, but the work that I did in industry was all because of where we were in the cycle at the time. I basically graduated at the beginning of the early 2000s cycle. I ended up doing generative exploration work in industry prior to coming to, capital markets, and then now making the transition more recently to corporate. So that's who I am. Solaris Resources is a copper growth and discovery story. And basically what you have in the company is a very special portfolio of assets that was taken on by the Augusta Group with the goal of surfacing the value there and then selling on these assets as we get deeper into the copper cycle. Obviously now we're just at the beginning. And the Augusta Group, you're familiar with, Jamie. I'm sure your listeners are familiar as well. Has a totally unrivaled track record of value creation, specifically in the niche of exploration and development in the mining sector. And so they've realized exit proceeds of over $4.5 billion through a series of transactions and generated a further $4 billion of investment gains for their followers over the past decade. And so Solaris is a major focus of the Augusta Group currently, alongside the other companies in the portfolio. And basically what we're doing is applying the same strategy that has made the Augusta Group successful in its other endeavors. And so that's obviously starting with a world-class asset, which we have in our flagship Warintza project within this portfolio. There's 6 assets in the portfolio, but the Warintza project is an obvious starting point because it's a world-class asset. And the hard part there, of course, was the discovery, and that was made by David Lowell, and then came to us through this portfolio and the spin-out transaction with Equinox. So starting with a world-class discovery, a high-grade open pit discovery, and then basically the key for us was to restore its social license so that we could actually get active on the project again. And that's something that we accomplished in 2019, which basically kicked off the modern history of this project and the further exploration of this project. So that's kind of the first thing that's critical in one of these Augusta Group companies. And then the second thing, of course, is funding your program in this case, we're fully funded all the way through to what we feel will be the point of sale for this project. So we've got over 90 million in cash, and then a further 90 million of in the money warrant proceeds, which are largely in the hands of management and our strategic supporters, Equinox, Lundin, BD, and so on. So we're fully funded through to where we think we can sell this project on. And then really just the easy part is actually doing the drilling. So taking that discovery, the high grade discovery that David Lowell made in the early 2000s, and then drilling it out to its potential. And the kind of threshold that you need to get to establish a world-class copper project for an open pit anyway, is approximately 1 billion tons. So if you can get to 1 billion tons of high grade resources in an open pit shell, then that's what establishes a world-class copper project. So that's clearly what we need to do with our Warintza project and the drilling that we're doing at Warintza Central. And then it's, in addition to the drilling, a job of technical de-risking. So we recently hired Chad Woolahan from Ivanhoe Mines. He's our VP projects now. And Chad at Ivanhoe Mines took their flagship Kamoa-Kakula project in the DRC through PEA, feasibility, and into detailed engineering to set it up to now transition well into pre-production and then production, which it's doing. And so we brought in Chad to do that same job for us at Warintza, and he's already gotten started on the various technical threads of work that need to be brought together to complete one of these engineering and economic studies, which we'll get to early next year.
Okay, so that's a lot of stuff for us to dig into over the next half hour or so.
Yeah,
and I think this is an interesting conversation for me because our lives have kind of spun around a few of the same things, if not always intersecting. You mentioned earlier, we both went to U of T, the same program. You were a few years ahead of me. And then I worked at Equinox at the time when we acquired Warintza, and at the time it was called Lowell Copper. And then as well, when we spun it out into Solaris, and then it was taken up by the Augusta Group and yourself and Richard Warke. But, when I go back to the beginning, I think, the first time I met you was when you came in to speak at a class that I was taking when I was in second year university on economic geology and kind of more of the market aspect of geology. And I think you'd graduated a year or two before, and you were working with a gentleman that was our professor, a guy named Glen Brown. Could you maybe give an idea of who Glen Brown is and sort of the influence he had in your early career?
Yeah, absolutely. So Glen is one of the best people that I know in terms of the quality of the character and his contribution to my life, and really just to the Toronto mining community at large. But he was an adjunct professor at the U of T. He was working at the time when I first met him as an equity research analyst at Haywood Securities. And so he was really just moonlighting as an adjunct professor at the U of T and basically trying to introduce the next generation of mining professionals to the capital markets aspects of the mining industry, and like with a particular focus obviously on exploration, which is more the focus of kind of the capital markets in Canada with respect to the mining industry and also the gold industry, of course. And so that's who he is. And basically he just sets out to do good things. I mean, this is a person who wants to make the world better. And so that's, his work at the U of T and his contribution to, educating students beyond the the agenda of their course programs is his way in which he does that.
Yeah.
And so, I'm one of the lucky ones, and that I've been able to, to benefit from that and like realize benefits from that. And, in the, for example, I got my start in the industry basically as working as his assistant or associate or junior associate or whatever on a summer term. And then, building my first set of relationships in the industry through that work, which I was then able, after I graduated from the U of T with a mineral engineering degree, to make use of, to find kind of further employment and find my way in the door of the industry. And so it's kind of all built from there. I honestly wouldn't, I mean, it's cliche, but it's true. I wouldn't be where I am today if it weren't for him. So
Yeah.
he's just an unbelievable person, and his motives are pure. So he is doing this because it's a good thing. And, there aren't enough people in the world like that. So it's amazing. He's an amazing person.
I was thinking the other day of the number of careers in this sector that he's essentially incubated at his own cost. And I've heard him refer to himself as essentially a halfway house for nerds, I think.
Yeah.
Where he like takes them out of university where they're basically useless, teaches them what they need to know, and launches them into the world. My brother-in-law, who's a fund manager, used to work for him. He helped me get my first job at a university, which is an exploration. And there's probably a dozen other people I could think of off the top of my head. And I just think it's interesting because I've known him and maybe a very, very small number of other people like him, but so many people in this sector can trace their career back to a person like that took an interest in them at a relatively early age and kind of backstop them with the credibility that they need to go out and do something interesting or do something special.
Yeah. And even more than just, kind of arming them with the education on the industry and opportunities within the industry. And so beyond that, and credibility, as you said, and obviously, connections through his network and so on. But even beyond that, I mean, this is a person who's put up money for his students to pursue ventures in the mining space at a point, obviously, at the beginning of their careers where it like you're just lighting the money on fire.
Yeah.
But because he believes in them and he believes in the value. I'm sure I've never actually talked to him about why would you invest in students, but I'm sure it's because he feels that it's a good thing. It's a good thing for the students and just a good thing overall to invest in young people and give them an opportunity to go deliver and do things in the world. So yeah, it's certainly not financially driven. That's for sure, whatever his motives are.
Yeah. And the reason I kind of bring this up is because when I met you in this class, you came in to talk about what it was like to run a junior mining company, and you were running junior explorcos when you were what, 22, 23, something like that, very young.
Yeah, well, so basically when I graduated, that was the kickoff of the junior mining cycle in 2003. Mm-hmm. And at that time, there was an opportunity, which seemed like a generational opportunity at the time, with the opening up of China's mineral sector to foreign investment. And so this was a sector, you looked at it at the time and you're like, okay, clearly, underinvested. A situation where we can apply, new thinking and technologies towards exploration and, consolidation opportunities and all the rest of it. It just seemed like a right kind of market for opportunity. And so I basically started a company to go and try and basically do deals to sign up some of these assets in this emerging new play in China, and then bring that to the public markets here in Canada. So that was that was my first venture. Ultimately, it wasn't successful. And then I ended up transitioning from that venture into a play in West Africa called Extra Gold, which was more successful. It's still, I mean, it's still listed today. It's like a 50 million market cap junior explorer today. So
okay. And then how did you go from being on the corporate side, starting, building, running these companies, to launching yourself into a career as a research analyst at a major bank?
So basically, yeah, I'd spent with Extra Gold, I'd spent like something like a year, more than a year actually, basically putting together, taking some concessions. This company was focused in Ghana, and specifically the eastern part of Ghana, which is a less established, less explored greenstone belt in Ghana called the Kibi Greenstone Belt. And so it was basically at a very like a grassroots stage of exploration. It was kind of looking at like the mineral concessions and an exploration camp and not much else. And so the job there was putting in place a baseline of exploration data. So going out and doing mapping work and then stream sediment sampling work to try and identify some areas to focus on with more detailed work. And then once we've done that, coming in and layering in soil sampling and then generating, actual drill targets. So it was really, so that was a lot of work, and it was like hard, kind of miles in the field in a remote area. And, ultimately it was just a personal choice to come back to, Toronto, my home, and take things in a different direction. And basically the opportunity within, to transition back to the capital markets came about through the relationships that I built up, in the work that I'd done with Glen at Haywood Securities. So there was actually an investment banker at Haywood Securities who I'd stayed in touch with, and he'd gone to a different firm, and he was looking for a research analyst at his new firm. And so that was the opportunity that I took back up to basically make my start in capital markets. That was probably 2005.
And for people who've never heard the term sort of research analyst, and particularly a sell side research analyst, can you give an overview of what that job actually entails?
Yeah. So equity research analysts are, publishing on, this is, Canadian publicly listed equities. And then, so if you're a mining analyst, you're covering mining equities. And for me, I was covering specifically, earlier stage companies, so exploration and development stage, and then later on in my career, emerging producers and full-fledged diversified producers. And so the job of an equity research analyst is basically to publish on those companies. So, to cover, put a baseline in place in the form of an initiating report, describing the company and its opportunities and risk profile and so on, providing baseline kind of estimates for its value, its valuation and earnings estimates, production estimates, et cetera, and then continuing coverage of them as they evolve with and report exploration results, resource estimates, engineering economic studies. Eventually quarterly reports become more important for producers and so on, and providing your, reaction and interpretation of those results to, largely, the focus of Canadian investment banks is on the institutional market. So these would be portfolio managers at, mutual funds and hedge funds and so on. but also the retail audience. So these would be investment advisors and individual investors are getting your research as well. And what they're seeing generally is a recommendation on a specific security. So buy, sell, hold, what have you, and target prices, and then estimates for all those various metrics that are important.
So I know I've gotten this question from people a lot of times, and I'd love to hear it because I've never actually talked to someone who's had that role before. But how do sell-side research analysts, I guess, manage the conflicts, right? Because when you're working for a bank, often the bank is working with a company. On the banking side, the bankers, they're helping to raise money, or they're helping with M&A, or they're helping any other things. And then you have the research analysts that are there to just provide an objective report about what this company is worth, whether it's worth owning. Obviously, there must be, if not direct, indirect pressure to the companies your bank is working with. Obviously the bankers who want favorable reports on that. How do you manage your independence as a sell side analyst to still be able to be objective, to be able to provide, I guess, as a most accurate evaluation that you can?
Yeah, so obviously it's a challenge to kind of balance the interests of the firm off against the interests of clients. But the way that I did it successfully was to just to get in front of the process and identify the companies where there'd be a natural alignment, and so to initiate coverage on companies where you saw. In my case, when I was looking, I had a very specific process. What I was looking for was opportunities where I saw on day one an economic scenario playing out. So whether or not there was a resource estimate or an economic study or whatever, I saw the makings of an economic scenario there, so that I had basically downside protection there. But then what I wanted to see is world-class growth potential around that. So whatever that nucleus was, I wanted to see it be able to grow into something that would be world class. So, at the beginning of my career, that like in 2 cycles ago, that would have been, for a gold deposit, something like a 10 million ounce deposit, or certainly at least a 5 million ounce deposit. And obviously, as those opportunities have become more scarce, there's been dilution to what we call world class, right? The same is true in the copper space. So, it used to be that you want a billion ton, plus 0.5% copper open pit with infrastructure or something. And like now at this point, those kinds of projects just simply don't exist. We think we may have one with Barinsa, but that only exists by virtue of the social history, which held it in limbo. It prevented it from being developed in the prior cycles. So I need to see that nucleus there, which protects my downside. Then I need to see the world-class growth potential around that, and where you can identify that. I was able to do this over my basically dozen years as a sell-side research analyst. I averaged out at basically 1 takeout per year, and so if you can identify those opportunities like that, then you can be sure that. When you recommend that clients buy that stock, that it's going to increase in value, and that ultimately, and of course, from the bank's perspective, there's business opportunities along the way with the growth of the company. There's, capital needs, and then ultimately, when you get to the exit point, there's, an additional business opportunity in the form of advisory work around a takeout. And so you've got this natural alignment there. And that's really the key. And then you short circuit the potential for a conflict.
And what do you mean? Can you define what you mean by double down on 1 takeout opportunity per year? What does that mean? Or average down?
I'm just saying, like, this was the approach that I tried to apply throughout my career, and the result was, of all the companies that I launched coverage on, I averaged 1 per year, like across that 12-year period. Which
I see. Yeah.
And so obviously, like the key was, and this is something I prided myself on, was being able to identify those opportunities early, and more importantly, ahead of competitors, so that you could really get in and dominate the discussion around the name, the trade in the securities, and then obviously, the business flows from there.
So you said something interesting. When you started your career, when you're looking for your career as an analyst, rather, when you're looking for, say, a world-class gold deposit, you're looking for 5 to 10 million ounces, sort of, or a billion plus tons in a copper deposit at 0.5%. You mentioned those are, well, let me actually ask you this. Those are a lot rarer today than they were even 12 years ago, right? Now,
Absolutely.
like what, and this is kind of, I'm asking you for a back of the envelope idea here, but like, how much rarer do you think they are? Are we finding half as many? Are we finding 10%?
Oh, yeah. I've got, I don't have them all off the top of my head, but I could show you slides that basically, if you do things really simply and you just look at the number of discoveries with total inventories over 10 million ounces, and then you see this, like a simple bar chart over time, and you'd see a big spike of discoveries in the 80s and 90s, where you had basically growth in the work in Nevada, in particular in Carlin Trend, and then in through the 90s, You've got the discoveries in Peru with it opening up. Mexico was opening up just prior to the period, with some big discoveries, and then once those discoveries are made, they're gone, right? So they're no longer available. And then as you get into the 2000s, with the price picking up, you've got another spurt of discoveries and projects now that wouldn't have been economic at lower prices now becoming economic, and so contributing to that number there. So this is things like Detour Lake, for example, or Canadian Malartic. These are plus 10 million ounce inventories, but they wouldn't have been economic in the 90s cycle, for example. They were only made economic by the increase in the price. And now even those opportunities are becoming more scarce. So you're seeing, the absolute number and the quality declining, significantly in more recent years.
Yeah, I kind of want to talk a bit about this, because if it took 5 million ounces for you to get excited about something in 2005, someone sitting in your chair at a bank today, what do you think they're looking for? Is it 1 million ounces? Is it 3 million ounces? What starts to move the needle, given where we are today in terms of both, say, size and grade?
I think for gold now, world class is 3 million ounces. So it's gone from 10 to 5 to 3 over my career, and my career is not that long. So now 3 million ounces. If you can define 3 million good quality, like robust, high grade, or with favorable geometry, metallurgy, all the rest of it, 3 million good quality ounces is now, I think, world class.
And what I'm hearing too is you see people for a heap leachable project, say in a place like Nevada, having a 0.5 gram per ton, a 3 million ounce deposit. That's something to get really excited about now, which would not have been 10 years ago.
I mean, like, name one. That's what tells you, like what is the, who has a project, let's say, that is over 1 million ounces at 1 gram per ton, like a heap leach project in Nevada? No one. It doesn't exist. So what's a good quality project in Nevada now? Well, we think we have one, for example, with Bullfrog.
Mm-hmm.
Which, the Bullfrog project in Augusta Group, which was previously named Bullfrog. We took the company over. It had sort of a history of an inability to raise capital to fund a serious exploration program. And there was another component, a real constraint for them, was that they were missing kind of at least half of the deposit, which was on Barrick's lands, and they couldn't get a Barrick deal done by virtue of, just the credibility of the company. And so we've come in and basically consolidated that land package, and now we've raised a significant amount of money. So we just closed a financing just yesterday for $17 million to add to the treasury. It was already well funded, and so now we'll be able to embark on a really serious drill program. And if you look at the inventory there, so that's sitting at, and this is estimated at 1,200 gold, based on exploration work that was done when the gold price was under $300 an ounce, right? So if you only adjusted the gold price and did nothing, no additional drilling, you'd already be looking at a significant change. But then obviously now with the mindset of higher gold prices, like we think of the long-term gold prices being $1,500 an ounce currently, obviously you want to go and drill the extensions of these deposits and so on. But just looking at it as it is today, you've got over 600,000 ounces at circa 0.7, 0.8 grams per ton, heap leachable in Nevada. I mean, when we get back to that approach to looking at projects and opportunities, that's your nucleus that you want to look at, which, you've got the makings of an economic project there, or what should be an economic project. And then you've got this obvious multiple times growth opportunity around them with, normalizing the gold price to long-term estimates, doing the extensional drilling, doing the exploration drilling, and so on in a camp that's got a big, where you've got a big land package. It's a prolific camp, and you just haven't seen that type of work be done in the past. So, that's something that's special in Nevada in this current cycle.
Right. And that would have been highly mediocre a decade ago, but today it's very attractive.
Yeah, exactly.
So this is kind of where I'm leading along to this conversation here, is that, all right, let me see if I can phrase this the best way possible. Rick Rule's kind of been on the record saying, and I'm paraphrasing, that, we haven't had a proper exploration cycle in decades where people are incentivized to go out and discover new large deposits to replace the ones we've been mining out and using up over the last 20 years. And, as your experience, running companies as a research analyst, do you think, and I think there is, a massive disconnect to what the price of metals need to be to incentivize that growth and that exploration to where they are today? I mean, we've seen a lot of growth in gold over the last year, but even at $1,700, even at $1,800 gold, are we going to be able to get there? And, that we can have a similar conversation about copper, which I would say is in an even more challenging state.
Oh, it's up. There's no question that that's true. But of course, commodities trade on a spot basis. And so the price is determined, for a metal like copper, let's say, the price is determined generally at the 90th percentile of the cost curve. And so the market isn't pricing copper on a spot basis. On an incentive pricing, it needs to balance off supply and demand expectations out into the future. And out into the future keeps growing, because the time frame to bring one of these projects actually into production keeps growing because of all these constraints that we're putting on the mining industry, actually delivering projects from a regulatory and ESG perspective and so on. So yeah, the answer is unquestionably, we don't have the prices that we need to deliver the kind of supply that we need for the future. But that's how the market works. And so this is what sets up the cycles that we're going to have. We can see very clearly, just sticking with copper, that there's going to be a gulf open up between supply and demand. And so Wood Mackenzie and CRU keep revising. I mean, every 3 months they're revising their estimates for that supply shortfall higher. So just in the span that I've been at Solaris, I started at Solaris in late 2019. We've seen those estimates go from, and this is to the end of the decade, go from 6 million ton shortfall to 6.5 million ton to 7. And then just yesterday, I saw the latest numbers from Wood Mackenzie, and they've got the shortfall at 8 million tons. And so this gap keeps widening out because of the increase in demand expectations. It seems like every week we hear about another automaker that's going to be fully electric. The most recent one we would have seen was Volvo is going to be fully electric by 2030. And so that, so the electrification of transport, the electrification of industry, the decarbonization, so all these, green and renewable initiatives, these all being, highly copper intensive. These are what are driving those demand estimates, higher and higher. And then on the supply side, you've got peak copper fast approaching. This is driven by the physical constraints, the limitations of these mega mines, the top 10 mega mines of the industry have been the backbone of supply for decades, something like a quarter of the supply out of these top 10 mega mines. And in prior cycles, to meet the gap between supply and demand, these have all been expanded and expanded again. And they've basically been expanded to a greater degree this cycle to their capacity than in prior cycles. And so the future is about greenfield, and that's going to require much higher prices.
Right. And so when you say peak copper, it means that these mines have they've reached their maximal output. They're not able to just turn up the tap because demand is increased.
Exactly. And so there's a variety of constraints, but the easiest one to understand is just the physical dimensions of these, the geometry of these ore bodies. If you max out basically your laybacks and your pit floor space within the ore body, then you've maxed out your mining rate, and that's the physical limit on what you can do. So it's not an economic calculation anymore. And that's just one example. There are other factors at play, like in particular, in the main copper producing regions, which are Chile and Peru, you're talking about roughly a third of the world's copper supply. Water has become a constraint on the ability of these, not just the ability of the mines to, for new production to come on and for the ability of these mines to be expanded, but actually just in maintaining production itself without, curtailing production during droughts and so on.
So you talk about this looming supply gap. I mean, I know I don't like to ask people to predict what metal prices are going to be, but, what do you think the impact on copper is? We've, the last couple of weeks, we've been up around $4.20 a pound. I think historic highs are $4.63 a pound, $4.63. I mean, I hear people talking about, we'll have $5 copper. I hear other people saying, we're going to have $10 plus copper. Do you have a feel for the quantum of where you see it going in terms of commodity prices?
Well, that's amazing. I mean, I haven't heard of the $5 and $10 estimates, but I need to be following those people. That sounds like a lot of fun. But no, it's I thought, so I started this cycle. So basically after the pandemic with the kind of fiscal response that I was seeing and the way that China was leading the way out of the pandemic, it consumes roughly 50% of the world's copper. I thought that we would be through $3 by the end of last year. And then I was talking about $4 for this year. And so obviously we exceeded those numbers more quickly than I would have expected and to a greater degree than I would have expected with the way that things actually, played out. And so, and so the longer term forecasts that I've been putting out there are $4 to $6 copper. And with the price performance that we've seen and the way that these supply demand forecasts have evolved, which is to paint the picture of an even wider supply demand gap and more work that I've done, like understanding, where this supply is and what kind of assumptions are built into these supply forecasts. I actually think that there's upside to those estimates that I put in. So we could see, $6+ copper. And then when you come back to just the technicals, like look, if you just simply look at charts, which is ultimately what, I think a lot of people do and find more reliable than listening to, analysts forecasting based off supply and demand and what have you. In the prior two cycles, we basically saw the copper price quadruple or nearly quadruple over a period of, kind of a few years. And so in the mid 2000 cycle, that's what you saw. And then again in the post financial crisis cycle.
Yeah.
And if you think about where we started this cycle, it was at about $2 a pound. So what's a quadruple from there? Well, that's an $8 copper price. We're in approximately 1 year, we've doubled the price. And if you overlay it on those prior, price charts, it actually looks like we're basically on track to do that. So.
All right.
And that's kind of, that's a lot to take in. Like if you're familiar with, if you're a mining investment, those are kind of like talking about $6 copper and $8 copper. It just seems crazy. It's like those prices are unimaginable. And yet and yet, when you actually look at it, those kinds of numbers start to be, that's what everything is pointing towards.
Right.
And so,
but I mean, I guess it's no different than when you started your career and were, $300 gold and then
totally.
watching it run up to $1,200 and, like that.
Totally. And, there's not a lot in place to really stop it. Like with some of these other metals, you start getting into, demand destruction through substitution and so on. Like it's always the cap on whether you have platinum or palladium, surging higher, you get substitution between the two of them. And we saw that with nickel. Like you remember, like over your career, you remember when nickel went absolutely crazy. Mm-hmm. And so the prices just went through the roof. They were at levels that were totally unimaginable even a few years prior to that. And we did see true demand destruction that was driven by technology, like Tsingshan Group out of China, which is now the world's largest stainless steel manufacturer. They basically capped the nickel price by, the advent and popularization and then mass buildup of nickel pig iron capacity. And so that crucial ingredient to stainless, they had found a technical solution to provide. And that capped nickel prices. And now, of course, the nickel market, like if you look at the projections forward now for the nickel market, they're all centered around, demand for nickel in battery applications. And so you would have seen like recent announcements from Tesla about how they're partnering on an Indonesian project to, secure supply. Musk was famously tweeting about, nickel was the one metal that caused him concern about.
It's not a lithium ion battery; it's a nickel battery. I think he said.
Yeah,
like that.
and now Tsingshan is looking at solutions to address that part of the market as well, with taking this nickel, a pig iron, and then converting it to sulfate to use in battery applications. So you see those kinds of things happening. You see the same thing with cobalt and some of the other minor metals and, like cobalt-free batteries and so on. But you don't have this with copper. Copper is fundamental. It's absolutely, foundational to this electrification, and indispensable. There is no substitute for copper, really. I saw a recent study into this by Jefferies, a U.S. bank, and they put the price of copper where we would start to see this demand destruction take place through substitution at $10 a pound. So, I mean, that's like essentially saying it's just not going to happen. Period.
Yeah. Is there a metal that you are particularly bullish on that other people maybe aren't, that you really like and you think is kind of ignored by the wider markets?
No, I think that's kind of my point is when you do feel like you're ahead of the curve on something like that with some minor or specialty metal, you're probably going to end up being wrong, because the market will find a way to address the shortfall, either through bringing supply on that you didn't know about or through technological change. And so we've seen that. I mean, we see these manias all the time in mining. Minor metal manias. It's like, I remember when I was starting my career, it was in tantalum and, I think it was tantalum, and there was one other metal anyway. That was like, it was basically the cell phone mania. It's like, okay, cell phone growth is going to go exponential. This metal is critical to, it's in the, chips that are used in, or the wiring or circuit boards or whatever that are used in cell phone. And therefore, the demand is going to be X and the supply is this, and therefore there's this huge gap and the prices are going to go crazy. And ultimately, technology just addresses that, because you find ways to substitute out those metals for other metals. So minor metals you can have a lot of fun over a short period of time in minor metals if you can jump on board of one of those trends or bubbles as they're inflating. But ultimately, it's a perilous place to be.
And I often think about that. They're great to invest in if you catch them at the right time. I would be very cautious about running one of those companies. We saw this in cobalt,
Well,
we saw this in vanadium, where as soon as the company gets up and going, the price gets crushed after that, and people find themselves in a very challenging position.
yeah, and that's yeah, and I mean you're getting back to something that obviously I spend a lot of time thinking about is exit strategy. Before joining a company, you need to have an exit strategy in mind, unless your ambition is to just continue to earn a paycheck and accumulate years and years of service at a company. You need to have an exit, and in the mining business, that's basically it's about defining an economic project and then being able to merge it or sell it on, or getting into production and doing the same basically.
All right. So you've obviously had a lot of job offers over the year. You've had a lot of opportunities to do different things. Why was it that sort of Solaris and the Augusta Group stood out?
Yeah. I mean, I guess I can take that in two parts, but yeah, you're in your preamble, that that's exactly correct. Like I have had opportunities, and in fact I've had opportunities where I regret not having taken them because they worked out really well. But with Solaris, I couldn't pass on it because it was too good an opportunity. It comes back to the way that I view and screen opportunities in the mineral space, like with the recognition that all the value is created in the exploration stage, like the Wilson curve and so on that you're well familiar with. And so where you have an opportunity to get on board of the evolution of a world-class project from the very beginning, that's something that's really special. And Solaris, with its Warintza project, it kind of had it all, where you had the nucleus of a project that was basically economic on day one. Like, and analysts have published on, their economic models for a project based around the existing resource. The 2019 resource is just based on David Lowell's work from 20 years ago. So less than 7 kilometers of drilling going into that, and they're coming up with economic projects based just on that. And then obviously, there was multiple times like true world-class discovery, growth and discovery potential around that. It was evident when you reviewed the project, as I did, that the drilling was just scratching the surface. I mean, the holes were bottoming in strong mineralization. It was just a small area, basically around the discovery outcrop within this vast system of outcropping porphyries that had actually been drilled. And so it just the kind of opportunity that you see maybe only once in your career, but certainly not many times. And so I had to jump in it. So that's the Solaris part. And then the Augusta Group, of course, it's just got an unrivaled track record of value creation. It's where you would want to be, or one of the very few groups that you would want to take on a project like that with, in the mining sector. So, and so it just all came together beautifully for me.
So you'd mentioned there, and thank you for that David Lowell was the discoverer of Warintza. For people who haven't heard of David, I think it's worth touching on briefly his track record and sort of the credibility of, being a David Lowell branded discovery actually holds in the porphyry copper space.
Yeah. I don't know what the marketing impact is, to be honest, but David, what I can say for sure, was the world's greatest explorer. So he made more discoveries of greater consequence than anyone in history. And, specifically as it relates to copper, he defined the deposit model, the porphyry copper model, which now accounts for something like 2/3 of the world's copper resources. And he basically, at the beginning of his career, took that model and applied it in the most direct way possible, in the high deserts of Chile and Peru. So this is applying the model of the concentric rings of alteration that define these porphyry systems to outcropping examples in the high Andes. And he made a whole string of discoveries at the beginning of his career in that way. And and then of course, industry caught on and then, started copying his ideas. And so there were discoveries that weren't credited to him that were made because of his ideas, of course, as well, and his approaches. But actually the most prolific part of his career, this is where it becomes so amazing. It wasn't just about a brilliant innovation that then spawned a great deal of success. It's about continued innovation and continued dedication across decades of time that you see in this man's legendary career. So actually, this was the second stage of his career where he evolved his approach to discovering these porphyry systems, to then start looking instead of for the direct evidence of the porphyry systems themselves, the indirect evidence of these porphyry systems. And that's actually how he made the discovery at Escondida. It was by identifying the alteration products or the weathered remains of the alteration products of the porphyry system that was Escondida. And that project had passed through the hands of 5 prior companies, senior companies, significant companies with big budgets and specialists in exploration before that discovery was made by David. And then he went on and made a whole string of discoveries after that, right up until the end of his career. And indeed, I think beyond his career, beyond his life, he's going to be still making discoveries.
Yeah.
So he actually set us up with a portfolio of projects that were his targets for future discoveries that are now going to be tested posthumously after his passing. And so that's the legacy that he, that's part of the legacy that he leaves behind. So just an incredible, David's as much an incredible human, and it's a story of human triumph as much as it is one specifically about exploration and geological history. And so he transcends, our sector. And, it's hard to overstate what an incredible man he was.
And, just to put that into context for people that listen at home that didn't know David, when you say in the later portion of his life, he was making discoveries. I mean, I met David when he was, I think, about 88 years old. This was in 2015. And we met on a project in Peru. And the day before, he'd spent, I think, something like 8 to 12 hours on horseback riding around in the deserts, checking out another project in Peru. And so this is a guy that was 88 years old, traveling around the world with his wife, still obsessively looking for discoveries.
Yeah. And in fact, it continued right up until the end of his life. I literally got a long email from him on targets that we ought to pursue beyond our portfolio. And remember, we already have 6 projects in our portfolio. So we already have essentially a decade of work in front of us. And David's thinking about what comes beyond that and what we need to pursue to fill in those, the period that follows that right up until the end of his life. So I literally got an email from him in regards to that subject on I think the Thursday, and I found out that he had passed away on the Tuesday.
Yeah.
So I mean, it just never ended for him. It's amazing. I don't know what you say about that. Someone's dedication to what their contribution to the world.
All right. Well, okay. For those who are listening at home or watching at home, you might notice that I'm in a different location now. Dan's wearing a different shirt. And that's because our internet got cut out mid-sentence yesterday or the other day. And we're just going to pick up the last couple minutes of this conversation now. So sorry for the confusion. Dan, thanks for taking the time to joining us again. And as we got cut off, I was just about to ask you, I don't think anybody has any serious qualms, any serious criticisms of Warintza and what you guys are doing in Ecuador from a technical perspective. Everyone certainly sees the value there. When I do hear people look at Solaris with some uncertainty or have criticism, it comes down to the social issues and sort of the history of dealing with challenges with the local indigenous population, with, of course, the government of Ecuador, but you guys have done a lot to address that over the last couple of years. Can you talk a little bit about where you are today with, of course, the relationship with the Shuar and Ecuador in general?
Yeah, absolutely. And it was the same for us as well as the Augusta Group approaching this opportunity. You know, that was the key risk to focus in on, and to make sure that you understood both it's basically understanding the framework. And then once you understand the framework, then you can, from there, chart a course to mitigating the risk. And then once you've mitigated the risk, then, you know, strengthening the solution that you put in place around it to add resilience to the social license for the project. And what gave us comfort was that the framework, the legal framework around this project is crystal clear. So you've got a project that resides on the ancestral lands of the Shuar nations of Warrants and Yawi. And these two indigenous communities or Shuar nations are, think of them as, you know, to use like the Canadian analogy as First Nations, right? And then the ancestral lands would be like, you know, their First Nations reserve. Okay, so the project resides on their First Nation reserve. And these two Shuar nations have been registered with the Ecuadorian government since 2002, so nearly 20 years. So, and then they have rights to self-determination on their ancestral lands that are enshrined in the Constitution. So they're not subject to change. They're basically, you know, fixed in place. So these are the parties. These are the only parties that have any say in the future of the project on their ancestral land. So, i.e., they're not governed. They're not subject to influence from any outside indigenous groups, whether they're, you know, the Indigenous Federation or Shuar associations or what have you. So obviously the, you know, the development of mining project is still subject to, you know, the mining law and permitting and so on. But they're not influenced by any outside groups. Therefore, you're dealing with two communities, so essentially two actors, and therefore you're dealing with a situation which isn't subject to this incredible, like, sprawling complexity of interests that you would have in like the broader kind of indigenous community, you know, in Ecuador, where you've got competing interests depending, you know, in different areas depending on, you know, their particular circumstances, right? Like
Right.
It's one of the things that's challenging about when you're looking at indigenous people as a whole is that there's incredible diversity, right, across the country, and therefore, you know, in their circumstances and therefore, you know, in their interests. And so trying to address, you know, indigenous issues as a whole on a broad scale is a very difficult thing. But when you're dealing with, in this case, a very like a confined, constrained, very clear situation, it's much simpler. So like in total, our two communities have a population of about 500 people. And so those two communities, they have leadership councils, which are democratically elected. And then those contribute to basically the decision making for their communities. And those are the parties to the memorandum of understanding, which actually was the restoration effectively of the social license for this project that allowed the kickstart of exploration activities on the project in 2019. And then also the parties obviously that entered into the impact and benefits agreement that we have for the project that was signed in 2020. And that impact and benefits agreement is what provides certain. So it sets out all of the benefits that we have to provide to mitigate, you know, those impacts. So those are things like, you know, employment obviously is the biggest thing at this stage. We employ 184 indigenous people on our project currently, most of them from these two communities. That's essentially full employment. And then we're going to grow that employment footprint out to about 450 people by the middle of the year, because we're going from 6 rigs to 12 rigs. But then even beyond employment, and and the related worker training and skills training and so on that goes along that, we've got education programs, we've got actual community infrastructure development, like putting in a road, which we did to connect these communities and our project, of course, to the rest of Ecuador's road network and highway network. Community development in the form of putting in community buildings and recreational facilities, medical. We've got these neat containerized medical units that we put in to provide basic medical.
And Dan, I think it's maybe worth mentioning, how isolated some of these communities are, right? In terms of that, you can't, and I've spoken at length with your head of CSR. As I understand it, tell me if I'm wrong, but you either fly in a helicopter, or you're doing a 2-day walk to get out of there. Is that right?
Yeah, absolutely. I mean, that was the starting point when we arrived. And so, think through the implications of that. If you don't have any access to the rest of the country, then you don't have any meaningful access to opportunity in the economy. And so essentially what you had in these communities is just subsistence existences of hunting and so on. So, now we've come in and we've put in the road access to connect them up to the highway and the rest of the country. We've put in place, basic infrastructure, connectivity, like data connectivity through Wi-Fi. People have jobs now, and so they have stable incomes, and so they have access to, services and goods and so on. So it's a complete, you've basically witnessed in the period of a few years here in these communities, like just a sea change in terms of the quality of life for these people. So it's a massive improvement, and it's, and there's more to come into the future. It just continues ramping up, and we'll continue to get better for these people as a result.
All right. Well, so, we're well over an hour on this podcast now. And, I appreciate you coming back for another day to finish this up. The last thing I want to talk about is sort of the Augusta Group in general, what you guys are doing, what else people should be paying attention to. And I think we should maybe start with the recent sort of acquisition, by Richard Warke personally, of additional shares in Solaris, buying them directly from Equinox Gold, which is, of course, a significant shareholder. Can you give people an overview of what's actually going on there and, the implications of that?
Yeah, absolutely. So it was basically Richard and a strategic investor approached Equinox about purchasing a block of shares off them, so 10 million shares off them, together with some warrant rights at $8.25 per share. So an $82.5 million investment, and Richard represented 7 million of those 10 million shares. So that was a substantial investment. That was on its own nearly $58 million investment for Richard. And that's basically a doubling up for Richard in terms of his cash investments in Solaris over the last year. So he's now sitting at something about $115 million invested in Solaris over the last 12 months. So it's a massive investment, and also just a massive show of faith. So Richard he's not a charity. So this is profit oriented investment. And so it gives you an idea of the type of return that Richard thinks is possible with Solaris.
We've talked a lot previously about the copper space and your views on it, but where do you really see Warintza sitting here? I mean, we're both on the same page that we're entering a significant copper cycle, that there's going to be a major supply crunch. How do you think Warintza will weigh into that? I mean, do you, you know, 10 years down the road from now, what do you think people in this sector look at Warranta as?
Yeah, there's really there's two parts to the answer. So the first part is just the view on the copper cycle itself, and then the second part is really the industry dynamics and how Solaris plays to those industry dynamics. On the copper cycle, I think the best way to um, describe it is that we've just seen the first leg of what will be a structural bull market for copper over the course of this decade. And I think it'll take us to prices that were previously unimaginable for copper. Okay, and this is based on the supply deficits that are forecast across the industry. Pick whoever you want, CRU, Wood Mackenzie, Glencore, Trafigura, BHP, Rio Tinto. Everyone's looking at the same picture of massive supply deficits that are going to begin to open up between supply and demand in the next 2 to 3 years. And so prices are headed a lot higher. That's, I think, basically the consensus view on copper. I actually think that it's you have to go beyond thinking purely about price, and you have to think about the strategic importance of copper to basically this kind of this paradigm shift, this revolution, the green revolution, the electrification megatrend, which is of great strategic importance to the great powers of the world now, China and the United States. So I think that you're going to see that instead of copper assets just being considered alongside the rest of the basket of commodities, essentially being considered as vanilla, mining assets, garnering, vanilla mining multiples, i.e. low multiples. You're going to see a shift where people come to understand the strategic importance of copper, it being totally indispensable and foundational and critical to this, these revolutions that we have going.
And does it fill a place more like oil in that scenario, do you think?
Well, maybe oil at the peak, when we thought we were at peak oil and that oil was essential to, underpin economic growth. And so then it took on kind of a strategic importance. And that kicked off a whole bunch of, concerns in Canada. Like you remember the discussion in Canada about we're giving away our oil. And, and the Chinese and the Americans and so on are coming in buying up our oil. And this is a great crisis. So yeah, I think you're going to see the same thing. I mean, you can already see it in the metal space in metals like lithium and the rare earth elements, where you can see in the United States changing legislation, aimed at securing supplies, and in China, obviously China's out in front in terms of positioning itself for this coming competition. But I think the same thing, and in terms of the equities, you can see them trading at, multiples that reflect that scarcity and, kind of the premium value on these assets. I think that's coming to copper. I think that that's where the discussion is headed next around, the strategic importance of this metal to these ongoing revolutions. And so I think that we're going to have these same premium multiples arrive in the copper space. Okay, so that was a long-winded answer, but I think basically all of those things together give you my view on kind of the copper dynamics now and into the future across this cycle. The industry dynamics are just as important for a company like Solaris. The basic setup in terms of the industry dynamics is that, in prior copper cycles, the supply demand deficit was ultimately filled in by the expansions, sometimes multiple expansions of the mega mines of the industry. So if you look at the copper industry, it's dominated by, say the top 10 copper mines, producing about 25% of the world's supply. And so the prior copper price cycles were ultimately capped by those expansions, and they're, filling in the supply demand deficit. But I think that those mines, they've been expanded up against the limits of their capacity, their geometrical, kind of like physical constraints, the availability of water and power. And so I think in the future, in this cycle, there's an increasing recognition, and the big companies are talking about this. BHP, Rio Tinto, and so on are all acknowledging this. To an increasing degree in this cycle, we're going to see a contribution from greenfield projects. And so, like if you look in the most recent Wood Mackenzie numbers, they're actually putting the number of copper mines coming offline across this cycle at something like 200 mines. So that gives you an idea of the number of new greenfield projects that have to come in just to fill the gap, never mind to contribute to, this incredible ramp up in growth that we need. And so it's really the industry dynamics, this incredible need for new sources, greenfield projects, to contribute to supply that's going to place a premium on assets like Warintza within Solaris in this cycle.
Okay. And where do you think Warintza stacks up against its competition? What you see out there? What these, obviously not quite greenfield, but development stage assets that can fill this gap? How does Warintza play into that?
Look,
is it in the top 5%, the top 20%?
Well, it's tough to say for Warintza as a whole, because we've really only drilled the central porphyry within this cluster of porphyries, and there's exploration to do beyond that. But if you just look at Warintza Central, let's say, okay, we made a discovery at West. We're going to be drilling east and south in the second quarter for discoveries, and then we've got targets in the second half of the year. But if you just look at Central alone, and compare the potential there against the very best copper development projects in existence currently. And so at the top of the list, I'd have a project like Anglo American's Quellaveco project in Peru. But, for Canadian resource investors, they'd be more familiar with Teck's QB2 project in Chile. Quellaveco's in Peru. That has a reserve inventory, Quellaveco, of 1.3 billion tons at 0.57% copper equivalent. Okay. The block that we're drilling, QB2 would be about 1.4 billion tons at 0.48. And these are both mega projects. These are, nearly $6 billion CapEx projects. Something like QB2, you're spending over $1 billion just on the water supply, with the desalination plant, pumping stations, pipelines up from the coast to get to a project that's at 4,400 meters of elevation with very little infrastructure around it. So these are mega projects, whereas a project like Warintza is situated at 1,500 to 2,000 meters of elevation, with abundant fresh water on site. The highway we've already connected to, it's just 22-kilometer connection to the highway. The power grid has excess hydroelectric power, cheap and clean power available on it. There's in fact a nearly $4 billion hydroelectric development called the Santiago G8 project. This is a fully licensed permit. It's just about to go out for tender. It'll be in operation by 2025. This is actually adjoining our project on its northern boundary. So this is an area very rich in natural infrastructure. That infrastructure saves, $2 billion off the front end of your construction costs for the project, just naturally. But if you look at the resource opportunity at Warintza Central, we're drilling off about a 1.4 billion ton mass of rock in our drill program, which will be completed in Q2, with the resource to follow in 3 or 4 months after that. And then the resource will just be whatever subset of that is mineralized above our cutoff grade and fits in a pit shell. And so call that, you can come up with your own estimate. Analyst estimates range from anywhere from 600 to 800 million tons. Let's say you're targeting 1 billion tons there. With the types of grades that we have, you're basically in amongst that Quellaveco and QB2 territory, maybe a bit short on tonnage, but you're more than making up for it on grade and infrastructure that you have at Warintza. So that's the very best copper development projects in the world that you're aiming to get amongst with Warintza Central before you get into West and East and South and so on. So that's how it stacks up. Nothing, in terms of potential, certainly has the potential to be the very best copper project. at the beginning of this copper cycle.
All right. That was a very clear and well thought out answer. Thank you, Dan. I think we've pretty much done it, hit all the things I wanted to hit. Thank you very much for taking the time. If people want to learn more about Warintza, about the Augusta Group in general, about you, where do they check it out?
SolarisResources.com is the best place for information on Solaris and Warintza. We've got a 3D model of all of our drilling, the historical drilling, the geophysics, the geochemistry, topography, and all the rest of it that people can play with on our website, as well as very detailed information on ESG and our responsible mining practices and our innovative CSR program and so on. And then for the Augusta Group as a whole, augustacorp.ca is the best place to go for information on the rest of it.
And you are pretty active in the mining Twitter world. How can people find you on Twitter?
Yeah, Daniel Earle 3, I believe, is my Twitter handle. So you can certainly reach me there or search for me under my name.
All right. Well, thank you very much. And ladies and gents, that is Dan Earle, CEO of Solaris Resources. Thanks again, Dan.
Thanks so much, Jamie.